So what are the fundamental drivers of prices? Some academics might say earnings. You know, Robert Shiller might say, well, there's a mean reversion around the CAPE ratio. People might say, well, macroeconomic events drive prices. But these are things, these are information, bits of information, and we respond to those bits of information. What we do with that information is we process it through our brain, through our wetware, so to speak. That information causes chemical shifts. Those chemical shifts change our propensity to behavior. We either are more likely to buy or more likely to sell. Ultimately, information changes our brain activity, literally, and it changes then whether we're likely to buy or sell. So in understanding information and doing sentiment analytics, we've got to analyze the bits of information that are most likely to drive behavior in a predictable way. So when we ask what moves prices, yes, it's information, but it's not only information, it's how information impacts our brain and our current expectations, what we believe about the future already. This is an example of just a cherry-picked example of a sentiment cycle in the markets. This is prior to the financial crisis. If I run this back to 1998, it looks quite similar. What it shows is that a short-term average of sentiment in the media, a 90-day average, as it drops below a longer day, say 200-day average, it creates a bit of a gravitational pull on prices downwards. This pink shading shows when the short-term average drops below the long-term average. And then when the long-term average of sentiment in the media rises up, and above, the short-term is above the long-term, there's a gravitational pull essentially upwards. So what this depicts is what's called underreaction. That complex or repetitive information tends to be reacted to inappropriately by investors. That is, we don't process it that quickly. We think about it, we mull it over, and then maybe we take action. As a result, information creates a lag that can be taken advantage of by investors. Now, there's also the phenomenon in behavioral finance of overreaction. So underreaction is the theory for why trends occur. Overreaction is for why mean reversion occurs. Now, overreaction refers to events that are usually surprising and unexpected, often vivid. So there was one academic study that looked at market responses to earnings reports, which create the famous post-earnings announcement drift anomaly. And then there was a second, they also looked at pharmaceutical drug company announcements. So within those companies, drug companies, they looked at earnings reports, and then when they announced drugs that are being released. Product launches like drugs are very vivid. You know, you might have a new cure for obesity or diabetes or whatever it is. When it's launched, there's a lot of fanfare around it. They found overreaction around product announcements and underreaction around earnings, which is fairly typical. So again, complex information, repetitive events, expert information often leads to underreaction, while more vivid, shocking events tend to lead to overreaction in prices. Now that sentiment analysis, that anomaly that I showed you is kind of interesting because, well, this is the Chinese, the bubble, the Shanghai composite. So in the China composite, since October of 2014, we initially saw a big spike up in positive sentiment around China related to the Hong Kong-Shanghai Connect when that came into place. So there's a lot of enthusiasm, and sure enough, there's a rally that begins in Shanghai, in the Shanghai composite. Then there's fairly static. It's pretty good, but it's fairly static. And then early this year, there's another burst of enthusiasm. The government begins to cheerlead Chinese equities to local investors. And the equities really rocket. However, then we see a big surge in conversation. Well, there's the Chinese bubble. This is very risky. We don't think the Chinese government can handle this. And sentiment begins to drop in the media. And sure enough, you can't see on the screen there, I guess, but that bubble top crashed down to where we are now in Chinese equities, down around here. So sentiment appears to have a lead-lag relationship. And I like this example because it's just happened. It's very relevant and very recent. We see this a lot. And that's what's really remarkable about the data. To understand how information flow impacts markets, back in 2004, I did a postdoc in neuroeconomics. We were looking at how people made risk-related decisions in an fMRI scanner. So we were looking at really emotional reactions. Now, if you've looked at behavioral finance research, you'll be familiar that most of it is focused on known risk. So risk where there's known odds, the outcomes are known. But as we discussed earlier, there's also unknown risk. There's odds when we don't know the situation, which is really characteristic of financial markets. We often don't know. Now, we can make assumptions, but the future is very uncertain, and we don't even know sometimes what we need to know about markets. So when we're looking at information flow, we need to understand various dimensions. in this research that we were doing back in 2004, we saw that how we described a gamble determined how people would behave. So if we described a gamble as potentially risky, even if it was a coin flip, do you want to engage in a risky coin flip? Or do you want to engage in the coin flip with a fair coin? Those two different words, risky and fair, it's a coin flip, right? Changes people's behavior, the two words that are used. And you'll see predictable shifts in group behavior as to whether they'll accept a risky coin flip versus a fair coin flip. It's the same coin flip, obviously. And in fact, what's interesting is the substantial shift is really related to the information. Some of the biggest movers of group risk-related behavior are related to the words that people see. So from this, we became very interested in how do we mine social media, news media, and how do we understand how it affects asset prices, and can it do so in a predictable way? So as I said, we've been doing this for 11 years, and in 2011, we partnered with Thomson Reuters. Now, we've got a very large data series from 1998 through the present for both news and social media, and we look at various dimensions because information, like I said about the words risky and fair, that's not positive and negative sentiment. Those are more nuanced. Fair is more about trust. Can you trust this coin that you're flipping? Risky is more about instability. Is there some volatility here that I'm not aware of? Is there some uncertainty? So there's various characteristics of information that matter, and that's what we ended up really working on. So like I said, we're looking at news and social media. We actually produce separate feeds. So I'll show you results from both news and social media separately today. When you analyze them in parallel, you see interesting differences, which we'll get into. We also have a very large content set. There's thousands of sources. We have many thousands of news sources globally from the Manila Times, Pack Alert, Xinhua, et cetera. There's lots of global sources. And then we have a lot of social media as well from various blogs, comment streams, tweets, et cetera. And our style of analytics is very different. So when you consider these results, keep in mind that if you want to go into detail, so if you use machine classification for sentiment analysis, if you are trying to look for a detail like uncertainty in information, there's a lot of disagreement about what uncertainty is, for one thing. So classifiers will have a lot of disagreement. Secondarily, it's very rare, for example, in some sources of text, for uncertainty to be discussed. As a result, you may get one article out of 100 or one sentence out of 100 that really expresses uncertainty. And those if you have a false positive ratio that's fairly high, you may get only 50% accuracy with uncertainty. So what you've really got to do is break it down. And in our case, we broke it down into very specific phrases and went over them thousands of times, very similar to what They Say did, looking at it in almost a manual fashion, hand curating, really human supervising what these machines were doing. And finding that when we added a grammatical interface, when we added part of speech, that we could really get very good accuracy on very detailed types of classifications. So you can't read this, I'm sure, but the fundamental example here is there's a sentence like Goldman Sachs analysts expect Apple to report expanding margins on tomorrow's quarterly conference call. This sentence trips up most language analyzers because, for one thing, who's the subject here? Is it Goldman Sachs or is it Apple, right? That's tricky in itself. In this case, it's Apple. So the classifier identifies it as Apple in what we call a score vector. Then what's important is margins. Margins as a noun usually means the distance of ink from the edge of paper or on a screen. But in the accounting sense, it's a very powerful word. The question is, which one is it? So if you are able to isolate by the domain, then you know that margins is an accounting term based on the context. And then what you see is, well, what's happening to margins? Is it just margins? So boom, I got a topic, margins. So what? Nobody cares about just margins. You care about what's happening with margins. Are they increasing or decreasing? Are they up or down? And then you care about the tense. You care about, is it something that already happened? Or is it something that's going to happen? That matters too. Other things matter as well as the credibility. Goldman Sachs expects this. Well, that's probably more impactful than Piper Jeffries or some other smaller boutique firm. Or Joe Bob in social media, not as impactful as Goldman Sachs, perhaps. So all of these things matter in doing language analytics. We don't catch all of them, but we do catch as many as we can, we believe. So we use these ideas, this concepts of being able to break down information into, say, future tense expectations about earnings to create very detailed indexes, time series indexes based on the entire information flow that's happening. So as news is happening, as social media is flowing, we'll break it all down into what people are saying, their sort of tones and complex topics. So how much are people talking about litigation within a particular company or innovation in that company, for example? Do they trust the management team, or do they distrust them? Are they calling them thugs and criminals, or are they calling them reliable and dependable? Those comments, when you get a lot of chatter, you can actually discern the level of management trust in a company based on both social media and news media. You can also see macroeconomic indicators, like I mentioned, interest rate forecast. So you get these really interesting nuances like that. And then with currencies, you can see things like the amount of uncertainty, or also the price forecast. So currencies and commodities are notoriously difficult to measure sentiment on because you don't know who's on which side of the trade. So a consumer of crude oil is upset when the price rises, but a producer is happy, right? So that you have competing sentiments. So how do you really know the sentiment about crude oil? Well, part of it is the expressed direction of, I think prices are going up. So regardless of your position in the asset, you believe the price is going up. That's probably your expressed sentiment. You're essentially positive on the price. So as others have mentioned, it's important to understand sentiment relative to a particular concept. In this case, we have it on price. We also have another variable called long-short, which is based on this idea that bullishness and bearishness matter, or stated intentions to buy or to sell. So this is people saying, I'm buying it, I'm shorting it. That kind of commitment, social commitment that you say what you think that what you're doing. We also cover a lot of assets here. So there's thousands of equity indexes as well. 30 plus currencies, 130 countries. So you get a lot of when you get a lot of this coverage, and internally we go far deeper than this, but this is what we deliver commercially. And then the data is very easy to analyze. So part of this, our goal was to create time series indexes that are very easy, very rapid to analyze, because when you go with much of the sentiment data, there's a question: is this reliable? Is this signal that I'm finding durable? In the short term, you can be pretty confident that if you have highly relevant, highly novel news that's very clearly positive or negative, you can be pretty confident that that has a short-term impact. But longer term, you've got to understand really what are the flow of information. So as I showed you in those initial MACDs of sentiment, the general idea is that as sentiment generally becomes positive, people tend to take more risk. They tend to jump in, more likely to buy, for example. As it turns over, they slowly start to follow and start to sell. This is from Greece on May 6, 2010. Does anyone remember what happened on May 6, 2010? What market event? I heard flash crash, right, flash crash. We had CNBC, an American television station, on the ground with reporters standing there between lines of rioters and lines of police, Molotov cocktails flying over their head, speaking to American traders all across, and others around the world, saying, I'm here in Athens, it's a war zone, the Marxists are taking over. And frightening people, right? That's a terrifying thought. The socialists are rising up all over Europe. What's going to happen? Especially if you're American, the Marxists and all that. We're very scared of them. So you have this kind of reaction, this emotional reaction. And the question is, can that affect prices? Well, the CFTC SEC report says it was a large sell order. It was spoofing by Navinder Sarao from his little house in West London. They had these kind of technical causes. But again, what moves prices? What moves prices is what's happening in our brain that leads to behavior that moves prices. Information comes in, changes brain activity, changes our behavior, prices move. And when that happens collectively, when that happens globally by images like this, that movement can be quite profound. So this is a minutely, 60-minute average on a minutely data series of fear related to every company in the S&P 500. What you see here is before the flash crash, there was a big spike in fear, of risk aversion. Fear is risk aversion, or risk perception, just before the flash crash. This is at 2:42, there's a big spike in fear, 2:42 p.m. Oh, no, I'm sorry, 12:42, it's off the screen. Big spike in fear. Fear starts to, kind of stagnate, starts to drop, but already the trigger has happened. Prices plummet. And then after the effect, you see another spike in fear. Sort of after the effect. This is fear in reaction. So the interesting thing about sentiment is, again, you have sentiment that predicts, and you have sentiment that is in reaction to an event. Sentiment that predicts is one thing. Sentiment that reacts is capitulation, and sets up for mean reversion. Another way of looking at this is just pure sentiment. This is media sentiment from both news and social media. You see media sentiment declining from the open dramatically, a little spike, like maybe we'll be okay. Oh no, the news looks bad, and it drops. And this is, again, a 60-minute average, a lagged 60-minute average. And then the flash crash happens, people are in disbelief. They don't know what to think. What is going on? So that was a one-time example, right? This is the one thing, the flash crash. But now we want to analyze this information systematically. What are the lessons that we can learn day after day after day, week after week, with sentiment-based information or with information itself? What can we know predicts behavior day after day so that we can believe it's reliable and consistent in influencing behavior? One-off stories are a dime a dozen. We all have some of these. But what's more important are these consistent effects. So one of our preferred methods, which is performed by CJ Liu over there, who's not expecting to be introduced, is CJ, could you stand up? So CJ is our head of research. Most of what I'll be showing next, in fact, maybe all of it, is from his research. So I don't take credit for this, it's his. And it's pretty amazing what he's finding with his work. So we know in general that sentiment and news flow are nonlinear, right? We have events like the flash crash, boom. We have the fear rise in advance, we have the fear rise afterwards. What do we do with this? What do we make of it? Well, if information is nonlinear, then we need to decide we need to use that information to predict the future using models that account for nonlinearity, right? A multiple regression model sort of mashes everything together. But what if we only care about the outliers? What if all the action is at the outliers? Because as human beings who trade in markets, we pay attention to what captures our attention, the things that are vivid and dramatic, that are easy to remember, that are available because they happen repeatedly. That's what we think about. That's what emotionally primes us to take action. So we need nonlinear models. We need moving average crossovers that account for changes in information. We need decision trees because, yes, we're humans. We decide in a hierarchical fashion. We prioritize information. We can't use 1,000 pieces of input and equally weight it. We have to decide what's most important, what's secondary, what's tertiary. That's how we have to decide. So in our own research, we've used decision trees, moving average crossovers. Because of time limitations, I'm showing you only cross-sectional models today. They also account for extremes. So a cross-sectional model is rank everything by a given sentiment, for example, by the decile or the quartile at the top, short the one at the bottom, roll forward and repeat, do it again and again, and look at the arbitrage between those two extremes, between, in this case, the high stress and the low stress. When you arbitrage stress, for example, across US equities in social media from 1998, what you see week by week by week is there is a stress arbitrage here, an emotional arbitrage of stress. And it has accelerated in recent, well, actually, if it were on an exponential curve, it would just be a flat line, but we're a logarithmic curve. But it's impressive. Weekly arbitrage works in many things. Also monthly and yearly, we're seeing on many different assets, on many different indicators. So all of these models do not assume transaction costs because, again, we're going very rapidly across a lot of assets, and we don't know what transaction costs on some. And it's difficult to assume across all of them. So let's talk about it on the day-to-day basis. So how does information impact prices daily? Well, it actually varies a bit by country. So in more very sophisticated markets like the United States, where you have lots of people competing, what you see is that news about earnings forecast or news about optimism generally about a company, news containing optimism about a company, has somewhat of a daily effect on prices. Now, this is daily. There's a high transaction costs. I don't think these effects are huge. They're certainly very compelling. And if you're a daily trader, you could definitely take advantage of these. But some of the more compelling stuff I'll show you later. The point is that news generates daily momentum in prices, day after day after day. And this momentum is based on expectations about the future, specifically about earnings, but generally how people feel in general. Is it a good thing or a bad thing to invest in this company? Expectations drive behavior in many ways. Now, on a weekly basis, we see something very different. So on that example, good news happens, or people have positive expectations, they buy, prices go up. Positive news, positive price movement. In this case, what we see, positive feelings, negative price movement on a weekly basis. Now this is I'll skip ahead to that. Wait. So I showed you the example of stress from social media. So in this case, you're buying the most stressed stocks, you're shorting the least stressed stocks, and arbitraging that week after week after week. In this other example here, this is a variable we created called the Bubbleometer. We created it about 6 years ago. It measures the amount of speculation in an asset. Are people speaking with positive expectations, with positive emotionality, talking about prices flipping, like day trading, house flipping, the speculative mindset? Or are they more analytical, a little more pessimistic, talking about fundamentals? We find that when they're more speculative in their conversations, it tends to be a good time to short. When they're more objective and analytical, it's a good time to buy. This is, again, arbitraging, in this case, the 20 most talked about US stocks over the past week in social media. So social media certainly has a benefit here in trading, but it's contrarian, especially on a weekly basis. It's a contrarian indicator. And most of us talk about, well, we need enough samples to have statistical significance, so we really look at the short term. But we've seen this systematically for years and years. This pattern has been present. We identified it in 2007. I think we even wrote about it and talked about it. It's been continuing, as you can see, since then. It's a very common pattern. So let's talk about weekly momentum. So I told you about weekly mean reversion in equities related to social media. So social media like StockTwits here, like peers. So people might be getting excited in StockTwits, right? Do you think it's a good time to buy, based on your experience?
We actually sometimes think it was a sell signal.
Right, so that's the ad. So same with what we're seeing, so that's good to hear. The problem is, even if you tell people on StockTwits, even if StockTwits puts out an alert and says, guys, you're getting a little too excited about Tesla this week, it's very likely that just seeing the word Tesla will make people more excited. Well, they'll argue because there's a confirmation bias. People will say, I love Tesla. I'll buy more of it. What does peers know about Tesla? So there's a real danger. It's actually very difficult to save people from themselves in this kind of environment. And that's part of the reason that these patterns are so enduring. People consistently trip themselves up. But let's talk about currencies, because equities have mean reversion, but currencies tend to demonstrate weekly momentum. And I'm going to show you a model that CJ over there developed in 2012 and put on our website, and it's been updating every day. And many of you in this room, several of you, have seen that model and seen it grow over time, seen the value of that return grow over time. It's a real model that's been proven in forward testing. So using our latest data feed, CJ recently came up with some weekly momentum equity curves. So when you think about this, we see using currencies, so the currency arbitrage, take the top 8 currencies in the news last week, rank them by one of these indexes, uncertainty, for example. So rank them by uncertainty. Buy the 2 with the most uncertainty, short the 2 with the least uncertainty. Arbitrage that uncertainty, roll it forward week after week after week. This is the equity curve you get, okay? So this is an uncertainty arbitrage in currencies. This is another arbitrage of price forecast. So when people predict the price is going up, you buy it. Now, uncertainty is a little bit contrarian. Why would you buy uncertainty in a currency? That's contrarian, but price forecast is not. That's momentum. When people say a currency is going up, it tends to go up. If they say it's going down, it tends to go down. Now, I was just looking at this, and if you take the top 10 in the news and you look at the extreme 1 on price forecast, you actually get more than a 2.5 times return. So this is a scalable effect. The more extreme you go, the more powerful this effect. It's robust. In a sensitivity analysis, it holds up. Now, you can roll these together. So if you take uncertainty, and you take price forecast, and you take a number of other variables that all kind of look good, most of them have orthogonal information. If you look at those equity curves, they don't dip at the same time necessarily. They don't zig and zag at the same time. They zig and zag separately. So you combine them together, and you get an even smoother equity curve. So we combined CJ combined a number of them together here. And then this is actually from today. This is what it says today. And then you roll them together, and you can create a model. Now, you can't really see the currencies over here, but this is how it selects currencies on a weekly basis. So this is from 1998, so obviously you can't read anything. Suffice it to say, some currencies it kind of buys, some currencies it buys and then sells. So it's pretty objective. Some it just buys and sells differently every month or so. You can see different patterns here and how it decides what to buy or sell. And some of them are sparse because they're not the top in the news most of the time. But when they are in the news, then they might get selected. So this is a selection plot developed in R by CJ. And then this is the final model. This is this morning. It's got a 1-week sell on the Russian ruble, the Mexican peso, it looks like. Or no, I don't see the Mexican, oh yeah, the Mexican peso is in the middle. Euro, sell on the euro. Okay, great. And then we can see some of these long signals here as well. And then this is the in-sample performance in the white, and this is the outage sample in the blue, and here's the blow-up of the outage sample. It caught the Russian ruble devaluation, and because it's just a dumb, simple weekly model, it also was, caught the rebound in the Russian ruble. These models can be refined. We created very simple models just to demonstrate that there's value here. All of these models can be significantly refined and improved if somebody takes the time to do it. Our goal is to demonstrate that sentiment has a lot of value in many different ways across many different assets. So one that's very interesting is the value investing to us. So value investing has actually done very well since 1999. This is a 12-month holding period, taking the S&P 500 stocks, very liquid stocks, right? Take those S&P 500 stocks, then take from those the top 100 in the news, so that we're sure we have really a lot of buzz about these stocks. Rank them by their earnings to price ratio. Buy the 25 stocks with the highest earnings to price values. So that's essentially low PE, right? Value investing. Hold them for 1 year. Update 1/12 of the portfolio every month, so you have more continuity. Over this period, the S&P 500 was up 124%, but the value strategy was up a lot more. This is consistent with Ken French's data on his website, which is up about 9 times. This one's up about 12 times. Now, Warren Buffett, who's of course a value practitioner, says something else. He doesn't say buy low PE ratios. He says, we buy when others are fearful, we sell when others are greedy. Well, that's cool because that's empirically testable. So what if you add fear to that? So in this case, we take that top by value, we take the top by fear, and we look at the intersection between fear and value. So these are the value stocks that are feared, in the top quartile of fear. And this is a 50 times return on a 12-month holding period, buying and then rotating, as I described, 1/12 the portfolio monthly. So 1 year holding period, 50 times return, long-only strategy. Okay, so that's amazing. And that's the wisdom of Warren Buffett and Ben Graham and others who've said to buy on pessimism or buy on fear. But it's not only value that can be augmented by sentiment. Momentum strategies. This is a momentum strategy up about 6 times. Similar model, 12-month holding period. I'm running out of time, so I'm going to talk really fast for the next 2 minutes, by the way. So we see in social media that the amount of buzz, this is the popularity effect of Ibbotson. So Roger Ibbotson wrote a paper, Dimensions of Popularity, recently. It won some awards. Great paper. He was a bit mystified, though, about the momentum effect. But we see here that in social media, stocks that aren't talked about much in social media actually tend to have better momentum returns. That's a 25 times return. And then another variable we have, emotion versus fact. The more emotional stocks outperform. I don't know why that is. Kind of an interesting effect. I don't know why. Now, generally, just for standard arbitrage with sentiment, without augmenting a value or an investment strategy, we see that long-term anger is quite useful. This is Groupon. You wouldn't have wanted to be at Groupon after they IPO'd. That was from 25 down to 2.5. CEO was named Worst CEO of the Year on CNBC. That would be embarrassing, I think. He was then fired by the board later due to poor earnings. And there's some interesting cycle here. When anger goes up, it seems like the price goes down. When anger goes up, the price goes down, and vice versa. What's the relationship here? Is it a correlation or a causation? So we wanted to test anger, and we look around the world, and we see that anger across all different countries and equities, including China, which I didn't have space to put in here. Also, China, this is true. There is an anger arbitrage on a 12-month rolling holding period for equities. The US, Japan, Germany, Canada, China. So you can arbitrage anger around the world. Why is that? Well, anger has a lot to do with risk aversion. And often anger is related to the management team or the government of a location. So governance is a big deal, whether it's a company or a country. The media, when they think about bad news, they blame it on somebody. When there's bad news, there's a scandal, let's blame somebody and name him or her as the cause. So this is we have country data, as I said. This is global instability around the world in 2014. So the data is accurate. It's accurate in that this is what we read in the news. It may not be accurate in that there's actually more instability in other places the news didn't report on. But importantly, the news causes overreaction. So as Rothschild said 200 years ago, buy to the sound of cannons, sell to the sound of trumpets. So this is a sensitivity analysis of an arbitrage of government instability. Take the top 20 countries in the news, in the last 12 months. Throw out the non-tradable ones like Libya, Afghanistan, Iraq. Buy the top quartile, in this case buy the top 6 with the most government instability, short those with the least. But when I say buy them, I mean buy the major stock index of that country. Roll it forward since 1999. At the highest decile, you get a 20-fold return on that arbitrage. So here it is, just a quintile arbitrage, about a 15-fold return rolled forward recently. And you also see, on a company basis, management trust. It could be that as humans, we distrust management, or we believe that management teams are more powerful than they actually are, that institutional culture matters more. And I spoke to the Children's Investment Fund, I think yesterday, and the portfolio manager there was telling me, yeah, we look for companies where there's horrible management teams, but great value. Because we know that management teams are really discounted, but the institution is fine. The institution is making money. People know what to do. They do their jobs. Okay, I've got 1 minute, so that's good because this is my summary. So as you saw in this race through sentiment data, whether it's currencies or equities, and I've got lots of other examples, global stock indexes, there appear to be arbitrages with sentiment data. I tried to keep very simple models here to show you that this is simple because it's not a black box. News is what news is. You can validate it with heat maps and charts. You can see what's happening in the media. You can arbitrage it. It's pretty simple. It's taken a long time for the industry to adopt this perspective, I think because it seems more complex than it actually is. But I do encourage you to talk to me about this data. And we also have 2 team members over here, CJ, who already stood up, and Alexander Fafula. Let us know if you'd like to take a look at the data, because we love to help people. We have a whole quant user guide, and we show all of our results to you, so you can take a look at everything we've done. So please come up to me with a business card afterwards if you'd like to see this. Also, we have a free monthly newsletter about quantitative analytics and advice on how to get value from sentiment data. So please do give me your business card if you'd like to be on that list as well. All right, thank you very much, everyone.